My name is Megan, and I am San Diego 350's Youth for Climate Program Coordinator. And I feel so fortunate to be on this call with all of you and get to delve into a topic that is so interesting to me. As a young adult, I am hearing from supportive people in my life about the importance of planning for my future. Yet I understand that planning for my future includes not just lining up my retirement funds and building up my credit, but also ensuring that the planet will remain beautiful and inhabitable when I'm old enough to retire. So the question I have on the table for myself tonight is, how can my money reflect my values of transforming the world so that people can thrive? And leading us through this workshop tonight, we have two knowledgeable, passionate professionals working in the climate finance field. The first is a certified financial planner from the Bay Area. As the founder, president, and CEO of Green River Sustainable Financial Services, this person helps individuals, business owners, and nonprofits reduce the carbon footprint of their investments without sacrificing their performance. In addition to his professional work, our first speaker is on the steering committee of 350 Marin and serves as the board treasurer for Fossil Free California. So in the chat or using your reactions button, please welcome our first presenter, Patrick Costello.
Thank you. Happy to be here.
And our second presenter is the Director of Digital Strategies at As You Sow, the nation's nonprofit leader in shareholder advocacy, which seeks to leverage shareholder power to promote environmental and social corporate responsibility. He helps design and build data-driven websites like interactive climate finance, financial transparency tools, such as the fossil-free funds. Please give a warm digital welcome to our second presenter, Andrew Montes.
Hello, pleasure to be here.
Thank you. Wonderful. Okay, we will get started with our first speaker, Patrick. Patrick, I'm going to share my screen.
Great.
Here.
So hi, folks. I live in Marin County, which is on unceded Miwok land, and I've been an investment advisor for longer than I really care to do the math about, somewhere north of 25 years. And I've specialized in helping people align their values with their investing process for probably about 12 years. I published a book in 2013 about the topic, and I updated it in 2018. And really the first thing that prompted me to write the book initially was the realization after doing some research that investing in such a way that aligns with your values, and particularly focusing on reducing the carbon footprint of your investments and avoiding the fossil fuel industry, did not require a financial sacrifice. So I thought, the prevailing wisdom at that time in most retail financial companies, if somebody just walked in the front door of a Merrill Lynch or whomever, they'd almost always be told that, well, I don't know, if you want that crazy thing called socially responsible investing, you're probably going to end up making a big financial sacrifice. So I found that wasn't true, and that kind of was the impetus to publish my book. But let's go back to the PowerPoint, if you would, Megan, and just kind of take people through a few quick thoughts. And as my book, I talk specifically about low carbon, to be very specific about the number one priority that our firm leads with. Next slide, please. So this is just a simple Venn diagram. Really what we're trying to find is companies that have all the same positive metrics that we've always looked for in the financial planning business going back 100 years. We're looking for companies that are well run, have great products and services, in a word, strong investment potential. And we look at how we try to find the subgroup of companies that also have high scores in the sustainability area. There's a kind of an acronym that's taken the world by storm lately called ESG, which I'll define further later. But so I think this is pretty obvious. We're looking at the overlap. We're not replacing the time-honored way of evaluating whether companies have strong investment potential. We're keeping all of that, but we're adding an additional lens that we now have data behind proving that it actually improves outcomes for investors without even talking about the social and environmental implications. Next screen, please. So I always feel like one of the first things we have to get past is all this terminology that floats around. When I first came into the business, the terminology that people were using was socially responsible investing, SRI. So we have a million different terms now: impact investing, ethical investing. For our purposes tonight, we're going to all lump them into the same general category, which it's people that want to apply some kind of hierarchy of values to their investment process. Next screen, please. So here's a little diagram from our website. I'm sorry, it's a little dim. I hope you can see it. So ESG is kind of this terminology that's been very popular for the past 3 or 4 years, probably maybe even a little bit longer than that. And the E, the S, and the G represent sort of 3 different facets of a lens that we use to look at how a company operates. The E stands for the environment. What's the company's impact on the environment? The S is more the social aspect, the employee culture, employee benefits. And then the G really relates to how the company governs itself. And that has to do with things like diversity at the top level. What's the relationship between the board and the executive team? Do they just kind of rubber stamp each other's proclivities or desires, or is there true independence there? That sort of thing. Next screen, please. And so that leads to the reality that many of the large financial service organizations, individual companies, fund families, etc., they have taken ESG and they've really adapted it to their own needs and usages because there are no strong, bright line definitions. So it almost doesn't mean anything now when an advisor or a firm or even a company talks about how great their ESG scores are in general, because there's no way of knowing which of those 3 facets of the lens they are focused on. And if I had a little more time, I could actually show you, we could go to the As You Sow website that Andrew's going to talk about a little bit later. He may even do this for us and show that there are funds that are labeled something obvious like clean energy, ESG, whatever, that actually have really high carbon footprints and may hold just as much fossil fuel stock as the unmanaged S&P 500 index. So that's something to really look out for. Next screen, please. So I just wanted to give, I don't know how much experience. I think there's a wide range of investment experience with the attendee group today. And I think there are maybe some young people that haven't done much investing yet. So I just wanted to cover some of the absolute basics. The kind of the 3 basic asset classes we deal with in the center of the investment universe. Granted, there's lots of other alternative investments that are more obscure and frankly, a lot more difficult to understand. You've got stocks, which represent ownership of a company, and the share price changes, in microseconds during the trading day. And mature companies will also pay the shareholders a dividend. So that's a payment that can come in so that the investor may benefit from the stock price going up and from dividend payments that come in from the larger, more mature companies. Bonds are completely different. They exist in a totally different marketplace, and they're sort of a contract where you loan money to a company under certain very specific requirements. They promise to pay you an exact amount of interest at periodic intervals, could be quarterly, semi-annually, and they also promise to return all of your original investment at a certain date. So it's a much more predictable investment than a stock. but it also doesn't have the long-term upside potential that stocks have. So, and then the third sort of category, in any brokerage account that people have, there'll always be a cash component. And that is kind of a safe place to be. The only way that a cash money market account can go awry is if the firm behind it has significant financial problems. So we will move. If you're trying to help people navigate difficult times in the financial markets, you might move some money in or out of cash depending on what your perspective is. Next screen, please. And so I just wanted to take it one step further. When we talk about a portfolio, what we really mean there is a group of funds, which I'll talk about more in a second. But we talk about different groups of stocks and maybe bonds that have different attributes where the goal is diversification. And I'm trying to help you understand a little bit more, if you're kind of new to investing, what the different experiences you're going to have between stocks and bonds. Stocks are zigging and zagging dramatically, especially individual stocks. A stock like Tesla could go up or down by 5% in one day, or even more sometimes. Bonds are much more stable, much more predictable. And I'm just giving you an idea of the type of investors that are going to gravitate to one or the other, or a larger share of one or the other in this portfolio. So when you think of the word portfolio, try to envision a pie chart. And if you're a very young investor, and if you can actually make a contribution on a regular basis, such as monthly, you really don't have to worry at all about what the market's doing. And you could, if you're young enough, it's not out of the realm of practicality to go 100% stock, because you're going to be, if this is money that you're saving for retirement, you plan to leave it there for 30 or 40 years, you're going to get rewarded for taking on the heightened risk of stocks. So for a very young person just starting out, a 100% stock portfolio there's nothing wrong with that. You also have to kind of examine yourself and see if you really worry a lot. This quarter that we've just been through has been pretty bad for stocks. And, some people don't like looking at a statement that shows that they've lost a lot of money in the past month or two. So maybe even though you're young, you might not want to be completely stock. You might want to be 75%. But I just contrast that with an older investor who's more cautious, has already, accumulated some wealth, and mainly doesn't want to lose what they have, but they do want to earn a little bit extra as time goes on. That would be a bond investor, or a person that should have a higher percentage of bonds in the portfolio than the young investor. 60-40 is kind of a typical recommendation for a retiree. Next, please. So I just wanted to, once again, focus on the fundamentals for a second. With my clients, never is a strong, harsh word, but I almost never insert individual stocks into client portfolios. I feel like my expertise is picking the stock pickers. And by that, I mean the fund families, the managers of the funds. Now, a fund is just simply a basket of 50 or more, generally, stocks or bonds. Sometimes there's several hundred stocks or bonds in one fund. And the terminology that people get confused about is that we use the same word. We talk about selling shares of a fund, which sounds exactly like selling shares of a stock. But when you sell the share of a fund, or buy a share of a fund, you are either letting go of or taking on exposure to 50, 100, 200 different companies all at once. So funds are extremely efficient that way. And they automatically give you diversification. We're all tempted to home in on some company that we fall in love with and put all our eggs in one basket, and that usually doesn't turn out too well. And I just list a couple of the other attributes. Ease of trading, of course, because you can always, if it's a publicly traded fund, it could either be a mutual fund or an exchange traded fund. You can basically sell or buy almost any of those on any given trading day before the markets close. And if you like actively managed funds, you've got professional fund managers that pick and choose the stocks or bonds in that fund. You can find long-term 10, 15, 20-year performance histories in many different sources like Morningstar.com, and the daily pricing is very transparent. Next slide, please. And then my final slide here before we turn it over to Andrew is just that something to think about is that all fund families are not the same. And this, so just for example, you're building a portfolio and you want to have a fund that specializes in large US stocks. So you might look at a fund that's put out by, say, a big, huge firm like Vanguard, and you might compare it to a fund put out by a smaller, sustainable fund family like Parnassus, which happens to be headquartered in San Francisco. And so if they have pretty similar attributes, they have pretty similar long-term performance. In my case, I'll always lean toward the fund family that has an enterprise-wide commitment to sustainable investing. Because even if the Vanguard fund has good performance, you're still supporting a gargantuan organization that still funnels billions and billions of dollars to the fossil fuel industry and also has muddied the waters for investors in several different ways that we don't have time to talk about right now. But I just want to make people understand, and these are usually fund families that create mutual funds. These are companies that have been around for decades that always embraced either the older terminology, social responsible, sustainable, or now ESG investing. So I always would rather opt for one of their funds if they're competitive with a fund from a Vanguard or a BlackRock or an American funds. And the rationale, of course, is that little teeny chunks of money are taken, even if you're not paying very much, you might not be able to see it. But if you're working through somebody who works for a Morgan Stanley and you're using a Vanguard fund, part of your investment fees are going to Morgan Stanley and are going to Vanguard. And with that, I'll pass it to Andrew.
Awesome. Thank you, Patrick. That was a perfect segue because a lot of what I'm going to talk about today and show today is really based on that whole dichotomy between stocks and bonds, between funds, introducing major asset managers like Vanguard and BlackRock versus socially responsible investors, sustainable investors, whatever terminology you use. They all sort of have different meanings within the industry, but very broadly, I tend to use the term sustainable because I think that it really connects to people. This is about long-term sustainability, for the planet and for our personal finances. So I'm going to do a screen share here. I'm going to show some stuff that I work on with As You Sow. And I guess I should probably just back up just a minute here. My name is Andrew Montes. I am the Director of Digital Strategies at As You Sow. We're a nonprofit organization. We're actually celebrating our 30th anniversary this year. And we focus on shareholder advocacy. So a lot of what we do is going to companies and saying, hey, we believe that you could be doing something better in some part of your business model, be more sustainable, and basically trying to shift corporate behavior. What I work on is more focused on investments and looking inside investments and finding out what are we invested in, because it's usually not very transparent. So basically, we're going to talk a little bit about climate-friendly investing. We're going to touch on a couple of other things like weapon-free investing and prison-free investing and other angles of sustainable investment. We're going to talk about some major asset managers like BlackRock and Vanguard. And we're going to talk a little bit about 401k plans, because that is one of the main way that a lot of people who are in their working career are investing. Not everybody, so it's not the only thing we're going to focus on. But yeah, basically, I'm going to take you on a tour of some of the tools we've built. So this is us at As You Sow. What we've produced is a tool called Fossil-Free Funds. So this is a tool to help you be a sustainable investor, to find out what you're invested in. And so, first of all, why fossil-free investing? Because that sometimes people just know I want to do that, but why is it? There's actually more than one reason. The first reason that people come to sustainable investing, fossil-free investing, is because they've got personal values. They say climate change is a catastrophe, and I don't want to have my money in it. And that's great. If that's your reasoning, that's perfect. But there are other reasons. Another reason that people prefer to avoid fossil fuel investments is because of financial risk. If you are looking at, I don't know if anyone reads the IPCC reports. There just was another one that came out. But when we're looking at the trajectory of the global climate, And then we have companies that have business models that are not aligned with what we need to do to keep temperatures below catastrophic levels. You maybe don't want to bet on those business models sticking around. So avoiding financial risk associated with unsustainable investments is another reason. Some people like to affirmatively invest in the economic transition to a clean energy economy. So they might want to find investments that are actually, in solar, in wind, in all sorts of solutions like that. And then kind of a big reason why there's what's called, divestment, which we usually call it fossil-free investment, but it is to invest fossil-free is to divest from fossil fuels. And so there's an element of social stigma in which you're basically trying to send a signal to markets, but also to governments and to society at large that the business models of these companies, if they're not aligned with the Paris Climate Agreement, if they are out of alignment with keeping temperatures below 1.5 degrees Celsius, then that's an unacceptable thing to be doing. And so we want to signal that, hey, these business models are not poised for success. And think of it this way. If everybody's 401ks, if everybody's retirement plans has companies like Exxon and Chevron in them, it makes it a lot harder for governments to put regulations in place that are actually going to, bring these companies to wind down their environmentally harmful behaviors. So, you can protect yourself, you can align with your values, but also you can send signals. So this tool is really focused on mutual funds and ETFs, exchange traded funds, which is another type of mutual fund, very popular. We don't really focus on individual stocks. If you want to go out and buy individual stocks, you can absolutely do that. But most people do, we find, invest through these funds, these basket of stocks. One of the most popular ways to invest right now is what's called an index fund, in which you basically just choose some list of stocks and you say, that's my list of stocks. And you're not, the fund manager's not like wheeling and dealing. They're not saying, oh, I'm going to sell this one, I'm going to buy this one. So you probably maybe heard of the S&P 500. So the S&P 500 is a very popular index, and there's lots of index funds that are based on it. And it is a list of 500 of the largest companies in the US market. So what you can do on our tool is you can go in and you can type in a search term like S&P 500, and you can see that there's actually more than one option here because there's a bunch of different S&P 500 funds. But I'm going to go to this one, which is from Vanguard. Vanguard is one of the largest asset managers in the world. And you can actually see right off the bat that this fund does have fossil fuel investments. In fact, it has pretty significant fossil fuel investments to the extent where, on our site, we have rated the fund as a D grade. And you can see some of the major fossil fuel investments up here at the top. We've got ExxonMobil, we got Chevron, Berkshire Hathaway owns a lot of coal-fired power plants. If I scroll down here, you can see some more details. For example, you can see that there's in total 51 different fossil fuel stocks within this fund, makes up 7.7% of the fund. And in total, through this fund, Vanguard has $63 billion invested in different fossil fuel investments. And you can come down here and we have the full list. You can click see all. So, and specifically ExxonMobil makes up this percent of the fund. The fund has this many billions of dollars invested. That means that just through this one fund, Vanguard has over almost $7 billion invested in Exxon. And you can also see it broken down by a couple of different categories. So for example, we have a list of the top 200 carbon reserve owners. We have a list of top 30 coal-fired power plant managers, utilities that have still burning coal, coal industry, oil, gas industry, etc. So, how did we find these different companies? So for example, we have the top 200 carbon reserve owners, and you see Exxon and Chevron there. So these are companies that have a lot of the carbon that is still under the ground. They've gone out, they've said, hey, we plan to drill this someday. And then their companies are valued based on the barrels of oil or the amount of coal that they have under the ground. But the thing is that the science tells us that most of that fossil fuel reserves cannot be burned if we are to avoid the catastrophic effects of climate change. So they're trying to say, hey, look how valuable we are. We have access. We've found all of this fossil fuels. The scientists are saying, well, you can't actually burn that. So there's a contradiction there between what they're saying financially and what the science is saying. Obviously, coal is one of the burning coal is one of the biggest drivers of climate change. One of the #1 things that the climate science tells us is we need to move away from coal-fired energy. So these are some of the utilities. Many of these are US utilities that are burning coal here in America. And, they produce electricity. Look, we all love electricity, but we can't just close our eyes to the fact that coal is producing the emissions that are going to destroy the global climate. And so both of these, we work with outside organizations that do research and say, hey, so Carbon Underground 200, that comes from a group called FFI. They used to be called Fossil Free Indexes. They do the research. They find the 200 companies, the largest reserve owners of coal and oil gas. And then the Macro Climate 30, this is a group called Macroclimate. They use open source data on fuel sources for power plants to come up with this list of companies. And we use a couple of other data sources. There's one called the Global Coal Exit List, another called the Global Oil Gas Exit List. Industry classifications, there's a couple of different places, but ultimately it's about finding companies where their business model is, it's either a significant part of their business model, or they're such a big company that even if it's not the entirety of their business model, it has a big impact by virtue of them being involved in the fossil fuel operations, digging it up, refining it, or burning it for power. So this is an S&P 500 fund. So, okay, maybe you don't invest in the S&P 500 fund, or you will have some other fund you want to invest in it. So how do you find your fund with our tool? So we have a search bar here at the front, but we also have a search page, which is pretty useful. So if I were to say Vanguard, we'll stick with Vanguard here and press enter. And I'm going to close out this tutorial bit because I'm just going to show you. So we have a whole search page here in which you can do different searches to find the funds you're invested in, or to find other funds that you might want to invest in, sustainable funds that avoid fossil fuel investments. Our database, it covers about 3,000 different US mutual funds and exchange traded funds. It is pretty focused on funds that invest in stocks. Our methodology looks for investments in fossil fuel stocks. I'll touch on bonds a little bit later, especially if you're towards the end of your investing career. You may be more invested in bonds than stocks. I'll tease that it's something we're looking to add, but right now we're mostly focused on stocks. So you can use this, you can sort, you can filter. So for example, if you click search settings, you could do a search where, for example, you could say, okay, I want to look at funds in let's do a group, let's look at US equity funds. So funds that are invested in US stocks. And let's say we only want funds that have a sustainability mandate. They say that they're sustainable to the world. And you can come down here. Oh, and we still have Vanguard. So I'm going to click off that Vanguard search here. And then you could say, I want to sort by net assets. So I see like the biggest ones. And voila, now you have some different options. And you can see that they get different grades. So let's clear this search. Let's show you that there are some good sustainable options here. So what you can do is you can also filter by grade. So again, if you wanted to say, I only want funds that have a sustainability mandate. I only want funds that are members of a US SIF, which is a sustainable investing group. So these ones are really, really committed to sustainable investment. And then I only want funds that get an A grade in fossil fuels. And you can see a list here. And if you click through, this one is Parnassus. It was mentioned by Patrick, and it has an A grade. It does not have any of the fossil fuels that we look for. Parnassus is not to the size of Vanguard. The fact is that more people are invested with asset managers like Vanguard and BlackRock just because they're so big. So we do have a section here, major fund managers, in which if you are invested, with one of these asset managers, you can see that really all of them have hundreds or billions of dollars of investments in these fossil fuel stocks. So, Vanguard. So Vanguard has, they've got a lot of funds. We're focused on funds that are based in the US. We're focused on funds that are mostly invested in stocks. And so in our data set, we've looked at over 100 different funds from Vanguard. And you can see they've got over almost 13,000 separate fossil fuel investments across those different funds that they offer. It's about 7% of their total dollars across those 110 funds are in these fossil fuel stocks. See the whole breakdown, et cetera. If I scroll down here, you can see here, they do offer some funds that get an A grade or that market is sustainable, but not very many when you're looking at 110 total, and they've got only 4 that market is sustainable. And if you look at the list down here, you can see how many funds are kind of getting fairly poor grades on fossil fuels. So what can you do about this? One thing we encourage people to do is to let people know. So we have an easy way to just share a social media message, let people know what Vanguard's investing in. And we're focused on climate today. I want to really briefly show that we do have some other issues. So if I were to say, look again, let's go to that S&P 500 fund again. And I'm going to scroll down here to this report card. So we basically try to look at different lists. So we have a list of tobacco companies, we have a list of military weapon companies, and we come up with ratings for these different issues. And so it's not just climate. This stuff is all holistic. So you can see the S&P 500, it does a little bit better on certain issues, but really it does pretty poorly on a lot of different issues that are important to sustainable investors beyond climate change. I'm going to really quickly just show you, I don't want to go too deep into this, but we do have some additional stuff here on our search page. For example, we have a way where you can go to financial performance. So for example, if you wanted to set your search settings to a certain set and then say, I want the ones with the highest performance over a different couple of years, etc., however you want to do it. And then we have a tab that goes other issues in which you can basically see the full report card. And so for any one of these, you can just click on it and it's going to take you there. So for example, if I click on this A here, and you can see that Parnassus, this core equity fund, also gets an A grade, doesn't own any of the gun companies that we look for. So this stuff all kind of ties into itself. Let's see. I do want to also show that there's a couple of other things that we look for beyond just exposure to fossil fuel companies. So the first thing is the other carbon footprint. So a carbon footprint is looking not just at fossil fuel companies, but all the companies in a portfolio. So, cement, steel, aviation, shipping, these are industries that are not technically fossil fuels, but they have really, really high carbon footprints associated with it. They produce a lot of emissions. So this is a metric that takes a look at those types of investments. You can see that this fund also has a pretty low carbon footprint in addition to not being invested in fossil fuels. And then on the impact investing side, actually finding companies that have some sort of contribution or some sort of commitment to the clean energy transition. So you can see this one does have some investments in what we call the Clean 200. It's 200 companies that are leading the way. Not all of these are going to be like solar or wind companies. Alphabet is, that's Google, Apple, Adobe. Those are there because they've made really strong commitments. For example, Google, all of their data centers are powered with renewable energy. But this list also does have companies that are involved in solar and wind and et cetera. So the idea is like not just finding out what you're not invested in, but finding out what you are invested in. And then our most recent project is actually looking at retirement plans of major companies, because companies offer retirement plans and they're made up of these types of mutual funds. And a lot of people just say, I don't know any about this stuff. Just put it in whatever you put it in, and I just hope it'll be there later on. And the way that the companies then do it is they find these funds from Vanguard, from BlackRock. They're mostly index funds, and they do end up being invested in fossil fuels and whatnot. So for example, if I look at Amazon's here, Amazon, they got the name Amazon and their investments are putting the Amazon rainforest at risk. How ironic. And so, they're using a Vanguard fund as their default investment. You can see it rates poorly on fossil fuels. If you click on it, it's because this default investment is it's over 7% invested in fossil fuels. If I click back out, I scroll down here. We do our best to find out in total how much do employees in the Amazon 401k have invested in these different issues. And so, Amazon employees through their 401k have $600 million invested in fossil fuel companies. We think that they probably don't really know that. So part of what we do is we try to raise awareness to that. And so if you are invested in your company 401k, you want to make a shift at your company, we put together a toolkit, basically how to find out what you own, how to take action. So you can, for example, send an email to your plan administrator in your workforce You can try to connect with other employees at your workplace to put pressure on your company, your employer, to actually offer green funds, fossil-free funds. Really, we think it's about, if they don't offer fossil-free investments, you're basically being forced to invest in climate destruction. You're being forced to invest in a way that's also financially risky because you're adopting the financial risk of climate risk investments. So I'm going to break here to make sure we have time to touch on other things and to do Q&A. As you can see, we have a lot of different stuff we do. We have 7 different issue-based sites that look at different mutual funds and ETFs. But yeah, I think I'll pass it back to Patrick.
Thank you very much, Andrew. And I have to say that As You Sow's unbelievable series of search engines have been incredibly helpful to me and to my clients, really super valuable. And just to touch on one thing, Andrew mentioned bonds, and that's something that As You Sow is considering in the future, is having a bond search engine. And so I will just recommend that if people are considering bond funds right now and they want to see especially what the fossil fuel exposure might be of a bond fund, Morningstar.com has a lot of good information about that. And here's just kind of a story from the front lines of what I do and what we do, is that I took a look at, Calvert is kind of the largest sustainable fund family that enterprise-wide has always been committed to sustainability. And they have a bond fund that they call the Green Bond Fund. And as soon as I looked it up on Morningstar, I saw, oh my God, it's like 4 or 5% exposed to the fossil fuel industry, almost as much as the S&P 500 stock index. And I guess I would say that one of the dirty little secrets about the bond market, that there are really a large number of bonds that have been issued by various companies, maybe not the big name companies that have the reserves, but all these peripheral fossil fuel companies that service the pumping and the drilling facilities. And many of them, especially companies involved in fracking, they have had lots and lots of bonds floating around. They pay an extra high interest rate to attract investors because their operations are dangerous and up until last year, not profitable either. So don't take your eye off of bond fund exposure to the fossil fuel industry. So I just wanted to kind of wrap up my presentation here. First, I wanted to just say one thing quickly. You can tell by what Andrew's site presents that it'd be pretty easy to fall into the paralysis by analysis syndrome. So when I'm talking to people that are venturing into sustainable or ESG investing for the first time, I say, look, why don't you and your significant other get together and go somewhere privately and hammer out a hierarchy of values or of what your priorities are going to be. And I start with the carbon footprint and the exposure to the fossil fuel industry. But you might have other things that you consider even more important. But if you just kind of go to all of the As You Sow websites and you look at all the different grades, you might find a fund that has A's in every category except one. And in that one category, it may have an F. I have found that in some cases, a company will get a very bad rating, a bad grade, so to speak, a D or an F in the As You Sow system, and it might be only due to one holding. So there's always levels of scrutiny. You can always dig a little deeper to make sure that your strategy is going to align with your values. I mean, I did find a fund one time that had a D in, I think, private prisons, and it turned out to be one holding. And then, these sources of data get updated periodically. And since the last data that As You Sow had found on this one company, they had gotten rid of that particular holding from that fund. So I looked at it that deeply simply because it had excellent performance. So these are the kinds of things that happen on the front lines. It's not the easiest thing in the world to do, but you definitely do need to have a hierarchy of what your priorities are going to be when you're making your value-based decisions. So I've just got 2 screens here, simple investing tips. As I've said before, I like funds for diversification and the public track record. Don't judge a fund by its name. Do the research at fossilfreefunds.org and or morningstar.com. If you work for a big company, Andrew helped us a lot with that already, but you can actually ask them. You can even get a group of fellow employees together and just kind of demand that the company add some low carbon ESG funds within the retirement plan to choose from. Here's an important thing. A lot of us nowadays are self-employed. And it could even be really something simple, like maybe you're a web designer, and you can actually create your own entity retirement plan that has highly, a large upper limit on how much you can deduct from your compensation and get a tax deduction for. You can have what's called a SEP IRA or even a personal 401k. So those are important things to know about. And this ties into my last slide. I'm ready for the next slide, Megan, if you could. Yeah, it's a little messy, but if you're going to be a serious investor, and certainly if you're going to help other people, your kids, your friends, you need to understand basic taxation aspects of investing. It's something that you just can't avoid. You need to know the difference between a Roth IRA and a regular IRA. And then and people who just do individual investing, not within the wrapper of a retirement plan, they have a completely different situation in terms of taxation when they're going to have to declare certain capital gains, interest payments from bonds. All of that are going to be taxable each year when you have a non-retirement investment account. So those are things that are really important to know if you want to be knowledgeable about what you're doing with your money. And the last time I spoke to San Diego 350, at the very end, this woman said, well, I've never invested before. Just tell me exactly what to do to get started. And I just said, look, go to a website of a really great little company such as Green Century Funds. They offer 3 funds. You're not going to be overly confused. One's all stock, one's a mixture of stocks and bonds, and one's international stock. And you can really just within that little, pretty narrow frame, you can get pretty good exposure because each fund holds hundreds of companies. And just go right online and do that. Open an IRA, open a Roth IRA. Or you can also go to an independent brokerage like a Schwab that'll pretty much let you access any fund that you're interested in. And then my last little tip is, especially if you haven't really done much investing yet, just once you've opened an account on, say, a Green Century website, just set up an automatic monthly transfer of $50, $100 from a bank account, spread maybe evenly between those 3 Green Century funds if you want, or maybe if you're really young, just do the 2 stock funds and ignore the one that's a combination of stocks and bonds. So I'm going to pass it back to Andrew now. We did want to just briefly mention banking. We talk a lot about, banks are a huge factor in funding climate chaos. And I'll turn this back to Andrew, but in the meantime, I will put in the chat a link to the latest report that tells us where all the big banks are sadly investing their money in not so good places.
Awesome, thank you. I'm going to be really brief here because I want to make sure that we have time for Q&A because I see some really great questions coming through in the chat. Banking is not something that, at As You Sow, we file shareholder resolutions quite a bit. And so we do file resolutions at banks, encouraging them to address the risk associated with lending and underwriting to fossil fuel operations. I can share a link here in the chat to something that I'm aware of. I can't fully endorse any of this. Just to be clear, I'm not a financial advisor. We are a nonprofit. Everything we do is for educational purposes. That being said, this is a resource that we have seen recently. I just put it in the chat, bank.green, in which these are banks that are really doing their best to actually identify as fossil free and to make sure that when you have a checking account that you're, that money's not being then lent to go be pipelines or fossil fuel operations. And I just want to tease from our tools really quickly that we are actually going to be integrating an aspect around banks. So some of those banks that are on the link that Patrick added, JP Morgan, they're doing a lot of financing of fossil fuel operations. We're going to start showing you within your portfolio, hey, if you have Exxon, we're also going to show you if you have JP Morgan. They're not going to be put at exactly the same level, but it's going to be a new sort of lens to our sustainable investing tools. And then I also want to tease that on the bond fund side, So again, we're mostly focused on stock funds. There are these things like Patrick mentioned of 60-40 funds or balanced funds, target date funds. There's a lot of different terminology, but funds that own stocks and bonds. We're hoping later this year to have a pilot program that's actually going to look at some bond funds and identify fossil fuel bond investments within bond funds. So if you want to join our mailing list, you can go to fossilfreefunds.org. We got a place to sign up for your mailing list.
Great idea.
Wonderful. I think we're ready to move into the Q&A portion of our event. So I'm going to pass it to Nick and Patrick and Andrew, Nick will be fielding the questions and posing them to our wonderful presenters.
Awesome. Can you guys hear me okay?
Yes.
Yeah. Well, first of all, I just got to say, great presentation, guys. Really, really good. So we got a lot of questions. I think these first ones are for Andrew because regarding the website. You mentioned something about Amazon's only fund. They usually give choices. Does it reflect that in the website at all?
Yeah, that's a great question. So I was moving at warp speed, so I didn't show the full scorecard. But basically, the reason we focus on the default investment is because it tends to have the largest amount of investments in it. For example, in the Amazon plan, more than 50% of the assets in the plan ended up in the default investment. But correct, there is a list of other options, and on our tool, we show the scores for all of the options that we're able to rate all of the investments that are primarily invested in stocks. So there is actually one sustainable option in the Amazon 401k. So that's good news. Here's the bad news is that it has less than 2% of the assets in the plan have been allocated to it. And so, here's our position is that if a company is offering just one sustainable option in their 401k, and first of all, a lot of plans don't offer any, so you don't even have any way. But so first of all, if you offer just one, you're essentially positioning it as, not the norm, not the standard. Like, oh, you might want to do that, but that's not really normal. So that's basically a paradigm that we're trying to challenge. We ultimately think that sustainable investing needs to be the standard, that you can't just keep investing in climate destruction and say, hey, everybody else does it. So we need to challenge that paradigm. So yes, it's great that Amazon has a sustainable option. They have other options that are, different types of funds. So maybe they have more or less fossil fuels in them. But ultimately, we focus on the default because just most people, we don't think you should have to be an expert in this. If you just want to sign up for your 401k and be put in the default, we think that ought not be financing climate destruction. That's how we feel.
Good answer. This next one's also for you, Andrew. Someone asked, so if my retirement account has a Vanguard, like a grade D fund, are they required to change it to a grade A green fund if I ask them to?
That is an interesting question. So it kind of depends on this, like the way that you're investing. If you have a personal portfolio, you have a brokerage account, you have a lot of freedom to choose the funds you want. And even if you do it by calling them up and saying, hey, I would like to do it, ultimately it's your money. If you're within a 401k, you might have less freedom. Usually a 401k will offer between 15 and 20 something different options, and you're a little bit limited to that. More 401ks are starting to offer what's called the self-directed option. So you can actually get out into a broader window, invest in thousands of mutual funds. Again, that's great. You have access to sustainable investing. Here's the problem. That's a lot harder. You're putting a lot of work onto the person to have to then become an expert on all this stuff and go out and figure it out. Now, if you want to do that, we have the tools to help. But ultimately, if you're within a 401k, that's why we focus so much on, hey, that this needs to be the default. But if you go to them and you say, hey, our default is invested in fossil fuels, unfortunately, no, they do not have to offer you a fossil-free investment. That being said, if you organize with your employees, if you make the case, and if you keep making the case, even if you don't get an affirmative answer the first time, kind of the saying is the squeaky wheel gets the grease. So we really think that companies need to hear from their employees that this is what they want, that they don't want to be investing in climate destruction. Again, if you're within your personal portfolio, though, yeah, if you call up Vanguard and say, hey, help me find a green fund, like Patrick said, they might try to say, oh, you're going to lose money. You can tell them, look, actually, we think fossil fuel investments have financial risk, and that's what I'm trying to avoid. Ultimately, it's your money, and they should be able to help you.
Awesome. Awesome. So next one is for Patrick, and maybe you can kind of, these are like little short ones. So I heard that green bonds are only available to institutional investors, but not individual investors. Is that correct? Or
No, the European Union has really set the standard for green bonds, but there's lots of ways for people, individuals, to invest in green bonds. I even saw a friend of mine on this call, Sandy Emerson, who I think was interested in a local. I mean, you wouldn't believe how huge the bond market is. And there are municipalities that issue bonds that are specifically targeted to a specific green project that you can invest in. So that's the simple answer.
okay. Another short one for you, Patrick. Do most mutual funds have 50 plus stocks? Why so many?
For diversification purposes, because you never know what happens if Elon Musk jumps into one of his SpaceX vehicles tonight and doesn't come back tomorrow. What do you think would happen to the value of Tesla stock? So it's the whole idea of don't put all your eggs in one basket. And as a person I mean, there's lots of information out there about how quote unquote amateur and non-professional investors, because of the way the reptile brain works, and the amount of propaganda that we're fed, financial propaganda by the giant firms, inevitably people do the wrong thing at the wrong time when left to their own devices. So, and we also overestimate our own savvy and our own ability to make good decisions. So all of those things mitigate against long-term investor success. If you think you're just going to sharpshoot 3 or 4 companies and ride with them, good luck. Let me know how it works out.
Right on, right on. And that's a good point. I think we got time for like 2 more questions. So I'm gonna kind of put some of these together. I think either one of you could maybe answer this, but I know we talked about, someone wants to know about like short-term securities. So I know stocks are mentioned, I know bonds are mentioned. Is there any kind of in-between stuff that might be being looked at?
Well, let me just say, if somebody comes to me and says, look, I want to save some money, I want to earn a decent return, but I'm going to need to take this money back in 3, 4, 5 years. I mean, that's a relatively short time horizon. So the way we calibrate that person's risk tolerance, which is dictated by their circumstances, is the way we mix stocks and bonds. So if somebody says they have a 3 to 5 year time horizon, I'm going to recommend that at least 40% of the portfolio consist of a bunch of different bond funds, because they're much more predictable. So we use bonds, the shorter the time horizon and the more risk averse the investor, the higher percentage of bonds recommended for the portfolio.
Awesome, very good answer. And I think the last one, maybe both of you guys can touch on this because this one's really important. I hear it a lot too, is expense ratios. Do you find that it's more expensive? Do you find it's on par? Can you talk a little bit about the price of investing in sustainably?
Do you have anything to say about that, Andrew?
Well, what I can tell you is that on our tool, we do have that as part of our search table. So you can also sort by expense ratio. I mean, that is a fact that there are some investments that market themselves as sustainable investments and have higher expense ratios. And that is also true that one of the reasons that firms like Vanguard and BlackRock really try to market the idea of index investing, invest in the whole market, don't question it. We'll charge you lower fees because we don't have to pay a guy to go, choose which funds and what not to invest in. We're just going to follow the index. But it's all about trade-offs, because when you look at returns, if you're comparing returns between 2 funds, usually most sites are going to have them adjusted for fees. So if you find a fund that avoids fossil fuels and outperforms an index fund, that's going to be net of fees. So it is something to look at. It's true. And this is also something where we're really trying to put pressure onto the asset managers. Hey, don't put sustainable investors at a default. And there's definitely true that there are asset managers out there who are just taking their existing funds, they are relabeling them and saying, oh yeah, sure, that's sustainable. And then they slap a higher fee on it. So it's unfortunate. So that's part of the reason why we created our tool, is to make sure that all this data is super transparent, and you can actually find exactly what's in a fund, but also, who it's coming from. I also want to touch just briefly on the question of green bonds. So, again, we don't touch too much on investing in individual securities or individual bonds, but bond funds. So like I said, it's not something we right now have in our database, but if you find funds that are from, especially, and again, we don't advocate specific funds or specific asset managers, but what I can tell you is, if you're an asset manager that really has a commitment to sustainable investments, and then you find out that there's stock funds on our tools, you like their ratings, you think it works for you, and then you go to their site and you find out that they also offer bond funds, we can't totally vouch for it, but that might be an indicator that they also bring that same type of fossil-free investment commitment to their bond portfolios.
Very good answers. Very good answers. Back to you, Megan.
Wonderful. Well, thank you all so much for your wonderful presentations. Sorry that we couldn't get to all of the questions, and I've added them all to a Google document, and I'll try to get them answered after the webinar is over. I also added to the chat a resource doc from tonight. And before we go, I wanted to let you know about 2 opportunities in San Diego. The first is to be part of starting a climate finance campaign. And I'm going to put a Google form right here. So we're trying to build power around holding these institutions accountable in collaboration with Fossil Free California and other groups working on this. And then the second thing is my friend Christy is interested in starting a more informal group just to talk about how to align our values with our personal finances. Christy, do you want to talk about that?
Yeah, this was a super informative presentation, and to me, it was a lot of new terminology that I want to learn about, but just it's hard to absorb it all too. So I had this idea with Megan to create like this follow-up accountability, group. I'm like in my 20s trying to start, and I know that I need some friends to do it with me. So if anybody's interested, maybe you can reach out to Megan and we can connect and we can do this together.
Christy, I put your email on this resources document. Is that okay?
Sweet, yeah.
Awesome, great. Okay, thank you all so much. And if you want to share something new you learned in the chat to close out, feel free. And yeah, thank you again so much for being here.
I just want to add, I put in the chat asyouso.org/contact. If you have any more questions about our tools or you just have any questions about this stuff, please feel free to drop us a line.
And thank you so much. Thank you for inviting us, Megan. It was really a pleasure to be part of this presentation.
Thank you so much. Yes, and thank you everybody for joining.
Thank you, everybody. Have a great night.
Great presentation. Thanks so much.